Hello, friends, and welcome back to KiraForex Radio. Guess what? In today's video, I'll be teaching you a different way of approaching the market. To be precise, on derivative. Today, we are not doing that of currency pairs. Today, we are on derivative. So that should tell you that I don't trade only currency pairs. I trade synthetics indices on derivative as well. So on synthetic indices, we trade different assets. You can see we have different assets here. We trade the boom, we trade the volatility, we trade a crash. You can see we have a lot of assets here that you can trade, and most of these assets here are highly volatile, unlike the currency pairs. And also this trading view, if you want to get this kind of trading view, just go to your search engine and type tradingview.deriv.com or deriv.com trading view, on your search engine. So that is what you need to do, and you can get this kind of trading view, because this kind of assets you will not get them on the normal trading view we all know about. And guess what? The approach I'll be using here today is the SMC way of trading. Okay, so we are going to use the institutional method of trading. People also call it demand and supply. How the big banks trade, or the bank trading strategy, the SMC, the smart money concept. You have different names for this particular strategy, or how to analyze the market. So that is exactly what we are going to do today. And this is the trade we took. When it comes to this trading view, actually the derivative trading view, you don't have a playback, unlike the currency where you can get a playback. So this is the trade we took, and it was given out to my community members. Now, if you are not part of my community members, which is my Telegram channel, I'll leave the link in the description below. So this is the Telegram channel. As you can see, we give a lot of free signals. Then our signals are 85 to 90%. They play out so many times, so don't miss it. Join the Telegram channel very fast and gain some knowledge and get money for yourself. And also the Telegram channels are two. I have two Telegram channels. I have the main one, which is for my currency, and then I also have this one, which is for the synthetics. So I have two different Telegram channel, one for the synthetics and one for the currency. So this is for the synthetic. Do well to join. Now, without wasting much time, let's get started. Before we start, take some few minutes, hit on the subscribe button. Let's get in. This is going to be a straightforward analysis. Okay, so first look at this diagram we have over here. You can see that we had price breaking to the upside, picking up liquidities here, and then we also have price picking liquidity at the downside. So after this liquidity was picked, and this one was also picked, we had an explosion to the downside, causing a break of market structure, and then leaving an imbalance around this area. Like I did a video where I talked about institutional reference points, I talked about mitigated blocks, I talked about old lows and old highs, I talked about liquidity void, I talked about other blocks, I talked about a lot of things in one of my videos. So you can go back to my YouTube and look for that video. I can't really remember. I'm trying to remember, but I can't remember which of the videos I talked about. I listed all the institutional reference points. Okay, we have 7 institutional reference points, which I listed all. So now what are we waiting for? Because there is an imbalance here, we're waiting for price to come back and mitigate that zone and then fill that imbalance. These big boys, what they usually do is that they always want to fill two types of orders. So assuming they have like $6 billion, what they do is they first fill the 3, and then it will be left with 3. So imagine they sell. When they sell, they first sell out the 3 million, or yeah, the 3 million, and then they wait for buyers to come in. After buyers come in, then they refill the second order, which is the 10 million. So that is how they move in the market, and their movements are always big, causing explosion. So this is their first move. What do? We wait, looking out for some of the reference points. Once we're able to get a reference point, then we wait for them to come back and pick the second or fill the second order. So when they're filling the second order, that is when we also jump in as retail traders. And you can see that the pattern here is the same thing that has formed here, and this signal is actually given out to my community members, and we made a lot of money out of it. All right, so I forgot to mention the assets we were actually traded on. The trade we took the trade on this asset 1,000. Okay, the names itself dictates how they move. So we have boom, crash, they'll be booming and be crashing. Now when you look here, you can see that we had liquidity grabbed around this area. Okay, at the downside here we had liquidity that was grabbed around this area at the downside, and when you look here too, we had liquidity that was grabbed around this area at the upside. Liquidity was grabbed to the upside. You can see that we had price moving up, and then all of a sudden we had a break to the downside, this explosion to the downside. So we had liquidity that was peak here, and all of a sudden we had a break of structure causing a change. So this should tell you that this move is from what? From the banks. This is the 4-hour time frame. When we move to the 24-hour time frame, you realize that the candles look big. So this is the big move from the banks causing what? An explosion. Then we also have, now when markets move to the downside causing an explosion, it left something behind, which is our supply zone or mitigated block. Okay, so this is our supply zone or mitigated block or order block. That's how people call it. They have different names for it. So what am I expecting? I'm expecting that price will come there. Immediately price gets there, there'll be a reaction, because this is the first order that was filled by the bank, and this will be the second order. Now when we had this supply zone, we also have what we call imbalance. Okay, so we had an imbalance around this area, you can see, and the imbalance is close to the mitigated block, or how do we call it, the order block. Yeah, so we had an imbalance around this area, and anytime there is an imbalance close to an order block, there is a probability that price will get there and also reverse. The only thing I would not do here is, the only thing that will not cause me to sell here is if price moves up above this high and close with a body, or above this high and close with the body. Once price moves up and close with the body, I know the trend has changed again, so I am not going to take any reaction. But aside that, I'll have to move to the lower time frame and then look for an entry once price has gotten to this point with my confirmation and the reaction I have around that point. So like I said, I'll move to the lower time frame to look for an entry. So sometimes I move lower, even to the 5 minutes time frame, especially on there. Go to 30 minutes, 15 minutes, sometimes even the 3 minutes and 5 minutes. But now I am on the 10 minutes time frame. So this is the 10 minutes time frame right here. Now on the 10 minutes time frame, what am I going to look for? I'm going to look for supply in a supply zone. Simple, it is just like that. Supply in a supply zone. So the first thing that I saw here was this liquidity grab to the upside here, you can see, and then we also have a choke around this area. So once we have a choke around this area, what do I need to do? I just draw my supply zone using this candlestick. You know, it's always the last candlestick before the move. So I just draw my supply zone. I don't really do much, I just look for confirmation. Now after I drew my supply zone, you can see that price came back, tested that supply zone. It's as simple as that. Price came back, tested that supply zone, then we had that huge fall. So that is my confirmation. Sometimes I enter this market aggressively because of how volatile they are. You might not get this kind of formation sometimes you might not get this kind of formation, like confirmations like this. You see price disturbing the zone, and immediately we have what, the continuation of whatever we were expecting. But this time around, I looked for a confirmation. Well, it happened. We have other people who just enter aggressively. We can also enter aggressively, but I was waiting for a confirmation to see what is going to happen here before I take a trade. So we have it here, price got here, and boom, you can see the movement to the downside, and the selling pressure is still continuing. So aside whatever I have explained on the 10 minutes time frame, this is the daily time frame. Okay, I should have talked about that before the lower time frame, but let's look at something here. We have what, equal low here. So I am looking at a long sell from this side. I am looking at price to sell from here and take out the low back into this demand zone, because we also have an imbalance around this side that is supposed to be filled. This side that is supposed to be filled. So I'm looking at a long sell of boom 1,000. So I'm looking at price selling from that side to this side to fill this imbalance again, which is a demand zone before our next move. So I'm looking at a long sell on boom 1,000. So let's go back to the 10 minutes time frame. Go and look for our risks to reward. So definitely means that this is how it's going to be. So our take profit is going to be somewhere around this area. But let me go back to the 10 minutes time frame so that we can get a smaller risk than this one, you see. So you can see that the risk here is very big and huge. So our risk here will be 30 pips. Now when I do it, you realize that I'll put the stop above this side, because anything can happen. You can't charge this market. The market is not for us. You just do our analysis and allow it to do what it wants. So my stop loss here is what, 30 pips, 30 pips. And our risk to reward is 1:11.39. That is a very good risk to reward. So when you move to the 24 hours, what will be our reward? Because we are taking a very long sell on this asset. So back to the 24-hour time frame, which is the daily time frame, and our reward is, look at this is huge, man. So this is our reward, almost 1,871 pips, risking only 30 pips. This is a very good risk to reward, but all you need here is what, patience. And once price is moving, anytime we get to support or resistance, or wherever there is a nearest demand or supply zone, or any nearest support or resistance, you can break even or take partial. So you can take partial somewhere, okay, around this area. You can also take some here, you can also take some here, and then wait for price to mitigate this supply zone. So that is that for our analysis for today. So the pure analysis we did today is SMC, institutional method of trading. Thank you for watching once again, and I'll be back with another exploding episode. You know what you have to do, right? Click on the thumbs up button, leave a comment below, and also subscribe. I love to read comments. If you want me to do a video of anything you don't understand, just leave it in the comment section. I am here to help you with the knowledge I have for this past years. Thank you once again. I love you all, and peace out.